Hello, welcome to Chapter 6 of Business 1A, Financial Accounting. This chapter is going to cover fraud, internal controls, and then the second half will talk about cash. So with the description of cash, we are continuing our travel down the balance sheet. In this chapter, we will cover cash. In the next chapter, we will cover receivables. In Chapter 8, we'll talk about long-term assets. So I will record two parts, two videos for this chapter. The first video will cover fraud, internal controls, control of cash, and petty cash. And the second part of the video will talk about bank statement reconciliation and the ratio for days sales uncollected. So the internal controls is probably the most important topic in the financial accounting class. They're crucial for the company to prevent theft and prevent fraud. So we will briefly describe them here, but if you're an accounting major in the future, you will take most likely class called accounting ethics, where you will talk a lot more about internal controls. So incorrect financial statements. Guys, fraud in regards to financial statements fraud, could have two different reasons. Well, I said fraud. There could be accidental errors without intent in recording transactions, in applying GAAP. The second type is more crucial and more dangerous, and it's financial statement fraud. There is an intent for a person to deceive another person for personal gain or to damage that person. It could be personal gain. It also could benefit the company. Usually it benefits the company, but when the company misstates its financial statements, for example, overstates its net income, it could lead to higher bonuses for the top management. So through that, top managers that commit fraud, they also get personal gain. So this is from Chapter 1, the fraud triangle. So we believe there are three factors that must exist for a person to commit fraud, and they include opportunity, rationalization, and financial pressure. As managers, we really have full control only over opportunity. Rationalization, we have limited control, and very limited control for financial pressure. So opportunity means that the person sees that there are weak internal controls. There is an easy way to commit fraud, and there is a low perceived risk of getting caught. Rationalization, usually a person committing fraud thinks about, I'm not getting enough benefits or enough salary, I'm not getting compensated enough, I'm not respected enough, so I'm rationalizing stealing from the company to reward myself. And financial pressure, which is not actually always the case, but usually during in the fraud cases it does exist. It means that the person committing fraud must have some pressure to commit fraud, such as drug use or very high mortgage or the loss of job of the spouse or unpaid medical bills. So internal controls, all companies have to implement them. And when the auditors come in, well, first of all, you can hire your CPA firm to design internal controls for you. And when the auditors come in, they look at your internal controls and see if they're efficient and effective or not. So internal controls attempt to eliminate the opportunity element of the fraud. They focus on that opportunity element only. We cannot fully eliminate fraud, but we are diminishing the opportunity of committing fraud. And these are four purposes of internal controls: to protect assets, to ensure reliable accounting, to urge adherence to company's policies, and to promote efficient operations. In Chapter 1, we talked about SOX, the Sarbanes-Oxley Act, which was implemented by the US Congress in 2002. And these are some of the specific requirements, such as managers and auditors must document and certify the system of internal controls. The auditor's work is overseen by this public company accounting oversight board. There is a restriction on consulting services performed by auditors. You cannot use the same CPA firm to consult you, to design your accounting system, and then to pay them again and for the same CPA firm to come in and do the audit. You have to separate those two. You have to employ different CPA companies. There is a term limit, 3 to 5 years, on the person leading the audit. Also, there is a suggestion on actually changing your CPA firm once in 3 to 5 years. And there are harsh penalties for violators, including prison time with severe fines. I also want to mention here, there is a protection for whistleblowers, and also your CFO and CEO, they have to actually personally sign off on financial statements. So if they commit fraud, it's easier to prosecute them. These are 7 principles of internal control. Whatever internal controls you design, usually they fall in one of those 7 categories. Responsibilities have to be clearly established. The company must have adequate accounting records. We can insure assets, buy insurance, just like you buy insurance for your car or for your cell phone. And we can buy insurance for key finance employees that have access to finances. So if the employee steals from us, we can get paid by our insurance company. This is very important. We separate responsibilities. We separate bookkeeping, record keeping, accounting from the custody of assets. So if you actually ask a lame person, anybody on the street, what do accountants do? A lot of people probably would say they count money. In reality, accountants should never have access to actual cash, because then it would be easy for them to commit fraud. They have access to records, to books, not to the actual cash. And we have to divide responsibility for related transactions. So the person dealing with accounts payable should not be dealing with accounts receivable. The person getting payments and depositing them to the bank should not be the one making payments. We also have to apply technological controls and perform regular and independent audits. So the outcomes of a good internal control systems are decreased risk of fraud and theft, and increased reliability and accuracy of accounting records. We're serving our customers with financial records. By customers, I really mean our stockholders and lenders, who have to get accurate information to make their decisions. So the CEO and CFO, as I mentioned, sign a report each year assessing whether the internal controls are adequate, and then the auditors provide an opinion on management assets of internal controls over financial reporting, and they also provide their own opinion on companies' internal control. So let's talk about cash. So when we talk about internal controls over cash, the goal is to protect cash and cash equivalents, and these are 3 basic guidelines. I already mentioned that handling actual cash must be separate from record keeping. So you have a cashier who is handling cash, and you have accountants who do books. Cash receipts have to deposit it to the bank right away, as soon as possible, and cash disbursements should not be made by cash, with the exception of the petty cash fund. They should be made by check, because checks are harder to forge, and also, we can require more than one person to sign the checks. So this is a definition of cash and cash equivalents. If you look at any company's balance sheet, this is usually the first line on the balance sheet. Cash and cash equivalents. This is what cash includes. And cash equivalents include highly liquid investments, debt securities, that usually will mature in fewer than 90 days. So these are examples of these very liquid short-term investments that will become cash. It's usually commercial papers. Commercial papers are short-term bonds issued by highly rated corporations. Treasury bills, this is from the US government, and money market funds. So internal controls to cash receipts and disbursements. When we discover at the end of the day, when we record the sale, sometimes we fall short or over. So we cannot just ignore that amount. We have to use a new account called cash short and over. I like to call it short and over, because on the left side, on the debit side, we will record shortages, and on the credit side, we will record overages. So here is an example. Our cash register shows $550. It's shown on the cash register tape. It's also called audit tape. But when we count cash in the register, we are over. We have $555. So we have to record the actual amount of cash, 555 debit, but my sales have to be recorded at the cash register's tape, 550, and cash short and over, as you can see, since we are over, it goes to the credit side, to the right side. And the way I think about it, revenues have a normal balance on the credit side. So when we are over, it's an additional revenue. It's an additional gain. So it goes on the credit side. If we were short, it would go on the debit side. So for example, my sales were 550, but my cash was only 540. So I would debit cash short and over, and the debit side is the positive side for expenses. So it creates an additional loss or an expense. So cash short and over is a temporary account listed on the income statement. So here is an example of us being short. I'm supposed to have $625, but when we count it, I only have $621. So we debit $4 where we fall short. So when we receive cash by mail, and by cash I mean usually checks, we receive payments. Preferably two people are assigned the task of opening the mail. So the more people you divide the task between or among, the less chance of committing fraud. And the cashier, not the accountant, deposits the money in the bank, and the accountant records the amount received in the accounting records. If you're a small business, of course, it's impossible to have so many bookkeepers and accountants. So if you have an accountant, the accountant does your books. You as the owner should be depositing money. You as the owner should be counting cash, not your bookkeeper. So these are keys to controlling cash disbursements, payments, right? Payments. Require all expenditures to be made by check. Limit access to checks except for those who have the authority to sign checks. Let's talk about petty cash fund. Many companies decide to have a small amount of actual cash on hand in the office because it doesn't make sense to make small payments with check. You have to pay for for a delivery, or you have to reimburse your employee for a Bay Bridge toll, a few dollars. So it doesn't make sense to necessarily make every payment by check. So the company sets petty cash fund. A petty cash fund will make small payments for such items as postage, courier fees, repairs, and supplies. Since it's the actual cash on premises, we have to have tight control over it. So to establish petty cash fund, we pretty much write a check to ourselves. So we decide that our petty cash fund is going to be $75 or whatever it is, $100, $200. So you write a check to yourself. You debit petty cash, it's a new account, current asset. You credit cash. You place it in the safe location. You decide who is responsible for it. Again, cannot be an accountant or bookkeeper. It has to be office manager or the administrative assistant or a cashier. And when you operate the petty cash fund, the person responsible, the cashier, or the office manager is going to make payments out of the petty cash funds. And we suggest using vouchers, receipts. So every time you make a payment, you have a copy of the voucher that goes into the safe to replace cash paid out. And on the voucher, you write down the date, the person you paid it to, and the type of the account and the amount. You do not record the small payments every time you make a payment. Instead, you keep it to the end of the month, and at the end of the month, the cashier gives the information, the spreadsheet, to the accountant. So you can see here that we had $75, and during the month we spent $71.30, which means that I have to have $3.70 left in the safe, unused petty cash fund. So you count those, and sometimes you fall short or over, and you use that cash short and over account I talked about. So the company then has to reimburse itself for $71.30. We have to write another check for $71.30 to replenish the petty cash fund back to our maximum, which was $75. So this is how the journal entry is going to look like. Again, with petty cash fund, we only record petty cash fund twice a period. Once to establish it, and then we actually make a journal entry, I said twice, once a period to replenish it. When you replenish petty cash fund, there is no petty cash fund account impacted. You debit your expenses, usually expenses, right? So you can see here miscellaneous expense, delivery expense, office supplies expense. The only exception here, and you will have it in your homework, if we paid for freight in. Remember, freight in, it's not an expense, it actually goes as an increase to your merchandise inventory account. If we pay for transportation out, that would be delivery expense. But if you pay for transportation in, it would be a debit to merchandise inventory, and you credit cash for the amount you're right, for $71.30. That's the amount you are replenishing, reimbursing the petty cash fund. Now, sometimes we might decide that, my initial $75 was not enough. I want to increase the maximum to $100. So then, only if you change the maximum to increase the maximum of the petty cash fund, we would add additional $25 to petty cash, and we would write a check for $25 from our checking account. Or we might decide to decrease our petty cash fund from 75 to 55. So that's what we do. We debit cash, credit petty cash fund. Again, you impact petty cash only when you establish the account, and then only if you decide to increase or decrease the maximum amount. Every time you reimburse yourself, there is no petty cash fund impacted. As I mentioned, sometimes we might fall short or over when we reimburse our petty cash fund, and that's when we use our cash short or over account. So here's an example. Tension Company maintains a petty cash fund of $400. This is the summary information from petty cash vouchers for July. So we spent $79.30 for travel expenses, $93.42 for transportation in, which will become your merchandise inventory account, $55 for postage, and $32.48 for office supplies. Let's look at replenishing the fund if the balance was $137.80. So first of all, how much cash am I short, right? So I had $400 minus 130. Let me use the calculator here. So we had $400 and we subtract 137.80. So it means we spent $262.20. 262, let me write it down right here. 262.20. So this is the amount I will have to replenish. Let's double check and make sure that what we spent was actually $262.20. Let me add all of these amounts from the summary, from the vouchers, $79.30 plus $93.42 plus $55 plus $32.48. So I can account for $260.20. But in reality, I'm missing $262.20. So what does it mean? It means we have $2 short. So this $2 will have to be in addition to these debits, I will also have to debit cash short or over by $2 because that's how much my shortage is. And here is your journal transaction. Here we are. So look at your debits. Travel expense, merchandise inventory, right? Transportation in is not an expense. Postage expense. Guys, with office supplies, since it's the end of the month, you can debit the asset or you can debit the expense, if they've been already used up. And then you can see that debit to cash shorten over, and then I credit cash by the amount of 262.20. So this concludes the first part of the video. Make sure to practice with your petty cash journal entries. Thank you.